Welcome back to the channel. Today we're going to be going over the S&P 500 and the indexes, but we need to be talking about the Fed and what they are doing right now that could be detrimental for the market. We need to be looking at a longer term spectrum. Now, typically when you come here, it's more for day trading and how you see the market moving in the micro level, but we need to be taking a broader spectrum of a look of what's happening this past week and going into next week as well. I mean, are we pushing back down to lows or are we going to be pushing back to local highs? The S&P 500 is going to have the story for us. We are going to attack this information very fast and to the point. All I ask is you like and subscribe because we make videos every single day about the market and how we see it moving and giving you the best and fastest source of news possible. Let's get to it. So the first thing we're going to look at is actually going to be what's happening with the consumer credit. If you haven't seen this is going to be pretty crucial to the market, right? So US consumer credit has hit a high of about 20 years. We're going to go into an overall charting view of that, what's really happened. But the big thing here is the 41.8 billion in February versus the 15 billion of expected. And when we go to the chart, basically what consumer credit is, it's self-explanatory if you went to any type of high school or if you just read any of your bank statements. But you know what this is. Consumer credit measures the change in total volume of outstanding consumer credit that requires installment payments. It is closely correlated with the consumer spending and confidence. The figure can be volatile as it is often subject to sizable revisions. So could this possibly be some type of revision mistake? You don't really know, but what we do know is that the American savings account is at an all-time low, or roughly 45 to 60 year low. So tracking back to, back to almost the Great Depression type years, you're getting back to those numbers. So as we come back, what I want to do is look at this overall chart of what's happened with consumer credit. So this is the most recent, right? They expected to come out about 16 billion and you can be around 5 billion off. I mean, it's a substantial amount, but you can still be wrong. Previous was 8.9 and you came in at 41, topping expectations, growing that debt over 33 billion. Now you've seen pretty big months back here. We saw 39.99 back in November. We're going to talk about November. You saw back in June and May. You saw back in roughly March and February. What we're going to talk about is going to be this November one right here. So you saw this kind of went down. This could have been people paying off some of that debt going into tax season, going into the end of the year with their end of the year spending. But you're seeing that roll over right now, and it's finally hitting the credit line from some of that misleading information of, we're paying off some of this debt, right? So as we come back to the S&P, what I want to look at is going to be November. So you saw that November tape hit us right here. So I'm going to highlight this point just so you can see, because this is going to give you a lot of answers, if you will. So what we're going to do is highlight November. This marks November, and this is when we started to see the chop. So right here represents where November ended, roughly right there at the end of Thanksgiving. What happened? You ended up pulling back on the market from 47 at that top of the S&P down to lows of roughly 45. In a matter of a week and a half, you came straight down 200 points on the S&P. An absolute heartbreak of a week and a half. And we had seen so much upside basically since the end of September, just on a straight bull run. Now, you all also saw that was bought right back up and then an immediate dip back down during Christmas time as well, topping back off at about the new year, and then boom, the rest has been history. But what's happening here? Are you seeing that take place right now going into early April? We just got these numbers released to us, and is this foreshadowing another instance of critical volatility that you had back here? Are you going to start getting this wild volatility? Because we know 30 days after that information came out, boom, the market took a turn for the worse. And you were basically in this downtrend, not to mention Ukraine and Russia building up tensions to that downtrend, right? And then you broke above it roughly mid-March, and then boom, you're kind of still in this bull trend right now. So if we're looking at this right now, you have to agree, you are still in this bull trend. And in my opinion, you're trying to hit this local target up here, if not make a double top at 4,800. So you're still in the trend. And if you're looking at this, you're looking at this as an ABC correction. So you're getting your one level here. This is your original analysis, right? You got your first level coming here. You have your A is here. You got your retracement, your B, and then you got your C somewhere up here. So you're expecting another leg. However, with all of the news coming out, you have got to be concerned, because we're going to be looking at what the Fed said. And I've gone over this already this week, but we need to be looking and taking a deeper look at what's really being said by our government. So when we get into the Fed minutes, and this link will be down below, I've gone over this before, but I think we need to take a deeper look into what's really being said. So when you're looking at this from a blank point of view, the Fed marks out that the market participants almost universally expected a 25-point basis hike. And that's why you saw when you got that, you got your 25-point hike about right here, you shot straight up. Why? Because everyone was expecting that. And once you get some stability in the market, it's good for it. So they're like, okay, thank God we didn't get a 50-point hike. We're still having these tensions with Ukraine and Russia, but at least we have stability in the market. The Fed's not going to surprise us. But the Fed goes on further. Increase the target range for the federal funds rate at the current meeting. Moreover, futures prices implied that the federal fund rate would increase around 170 basis points through the year end, about 70 basis points more that had been priced in at the time of the January meeting. So yes, going back towards January, we need to be looking at the clock. What's really going on? Back in January, when you saw this dip, this is when we started seeing the Fed come out. They started saying inflation wasn't transitory. Spoiler alert. You started to get that realization of what's really going on, and you start really falling. Coming out here where we got those Fed minutes, they are now saying that this is even more detrimental. More rate hikes are coming. Bigger hikes are coming right here compared to right here when you started seeing that reversal in the market there. So they're hitting you back to reality. Not only are they higher, they're about 70% higher, 70% more basis points on the hike side. What you also know is that you went from expecting roughly, that's a rough three hikes going on this year, to seeing almost 7 to 9 is now expected from the actual market. That's from the Fed themselves. They expect 7 to 9 hikes this year alone. No longer 3 to 4. So things are rapidly changing on us, and you're seeing the market slowly react, and you're moving still in a bull trend. You're moving in a bull flag. This is the 4-hour chart. You're trying to pressure back to the upside, right? So as we come back here, they're telling you that we expect more hikes coming into this year, not less. We're not just easing on the market. And then they hit you with the softball right here. The Russian invasion of the Ukraine, however, constituted a negative shock to the global economy by pushing up commodity prices further. And notice they say further, they're not blaming it all on Russia. They're just saying it definitely had an impact on it to make commodities even more expensive, hurting global risk sentiment and exacerbating supply bottlenecks. Inflation abroad continued to rise, and it's continuing to rise right now, driven by recovering global demand, rising retail energy and food prices, and ongoing strains of global supply chains. The effects of the Russian invasion contributed, it's not the only reason why, to some of the inflationary pressures. And then they come up to really nail you. And this is where we start to see that they are saying that the developments in Ukraine spark liquidity strains across the market. So it's not only is it hitting you there, they start to really hit you when it comes to this. And again, I know you may have heard this before here in the channel, but we need to really go on to what's being said here. They talk about possibly getting that 50-point hike and how members favored it. A number of these, scrolling back up, I hate how they have this written, participants indicated, however, that in light of the greater near-term uncertainty associated with Russia's invasion of Ukraine, they judged that the 25 BP increase would be appropriate for this meeting. Many participants noted that one or more 50 basis point hikes over this year are going to be appropriate at future meetings. What does this mean? They wanted the 50 BP hike this past Fed meeting. They wanted it. However, despite what happening in Ukraine and Russia, and we've seen the tensions, they're slowing down right now. I am almost willing to bet coming out of the gate next Fed meeting, they are going to want to do this to a 50 BP hike. You have seen, and they're not just saying it's one or two Fed members. It's no longer just, Bostic. It's the whole Fed coming around to this. They know inflation's hitting us hard, and that's where things are getting interesting, because they are staying committed as well to the 2% longer run objective for inflation. And the only way to do this is to start raising those hikes. And they also have not came out and made any statements in this whole Fed minutes regarding the actual benefit that we've already seen from this, because you haven't seen a benefit yet. So as we come back to the S&P, what does that mean? Where am I looking at? I think top side pressure as of right now, I don't know if you're going to make new highs. I see if we're going on a scale of 1 to 100%, I would say you're at like a 30% of reaching new highs. However, do I think you could reach new local highs? I think it's 100% a possibility. I think it's very possible that you can start breaking out of this trend back to the upside. What do you want to see? You want to see a clear break once again right above that trend, pushing you back up. What would I be targeting? What would I be looking for? You'd be looking for an immediate double top of this region here, but you also need to notice this is going to be a big pain to get above as well. This 45, 75 on the S&P. If you get above that, it's going to be absolutely monstrous, and you're probably needing a test of this 47, 47.5, but 45, 75 is going to be huge. Until then, what am I looking for? What am I trying to expect? I'm going to get a little bit deeper here into the charts, about to the 15 minutes so you can see, but then S&P continues to not be able to hold the VWAP. It continues to not be able to ride the ADMA. It continues to just have not so good daily charting frames looking at this. So as we zoom in here, you're seeing that you're trying to make these higher lows. You are trying. You're desperately trying, as you can see in here. You're getting that level. You're pushing up here. Yes, that's good. And then you're also making higher highs on some time frames as well. But you're getting more into a wedge. So if you start to break out of this trend, you've got to be targeting, again, those previous lows to be touched, which is 44.50, which would have you trading in a clear downtrend over the next few days as well. So what am I looking at? What am I looking for here? If you get a break above this trend, which again, you have to notice, if you break above this trend, you're targeting that level there, and then a key bull run up to 4,700 on the S&P. If you start to break below this micro, smaller level trend, you're targeting back down to those previous lows back in beginning, April, right back down there, 45.50 roughly. From there, if you start breaking out of the actual bear flag, things could get nasty, pushing back down to 42.50, 42.70, and things would get really rough. But I'm here to tell you right now, there's an area of the market that I believe is kind of floating around, and I think it has plenty of room to run. And I mentioned it yesterday. It's going to be oil. As we look at oil, as you really look at what's going on here, the thing looks gorgeous. As we look at the 4-hour chart, a higher time frame, basically since that run in February, you had those massive highs. We traded that. We made a killing on that. But look at where you're sitting now. You're holding up those previous highs, right? Those previous highs you were making. You're holding it and you're sitting there now. And the key thing to know right now is you have your Russia ban finally passed here in America, and the demand for oil, specifically United States oil, is going to go through the roof. Now, if you're looking at specific stocks, you got Warren Buffett. So when he's been buying Oxy on Friday, it went absolutely bananas. We talked about it on Thursday. It went absolutely out of this world. You have Exxon going crazy as well. You have CVX, which just made the deal in Venezuela. They're back to 170. They're going to be breaking these local highs very soon as well. But we got the boy that I'm playing. It's USO, United States of America Oil Fund, and this thing looks beautiful. You're sitting right back with those previous lows. You have a little bit of a gap there, but I'm telling you, I absolutely love it. If you want a little bit of a safer play, you're going to definitely want to grab some leaps at least a month out. Okay. The riskier ones I do like as well, 1 to 2 weeks out as well. Get a few of those, but you probably want to straddle those if you're looking. However, I still love this position and I see massive upside, specifically with the way that you moved the last time you had this big of a run on oil. And I think USO is definitely lagging behind. Oil has got to be on the top of everyone's watch list. Now that's going to wrap the video up. If you got anything else, please again, like, subscribe. It helps out the channel tremendously. Content is coming every single day. Educational videos as well, going over how I'm charting. You have to go to my page and look at that for the playlist for educational content, but I'm explaining exactly how I look at the market for day trading specifically, not for longer term. It's day trading content only there. But again, more content is coming. Have a good weekend, traders.